Bonjour, my name is Claude Perron, Chairman of Crystalline Management, an asset management firm founded in 1998 with a focus on arbitrage strategies. Je vous souhaite à tous la bienvenue, quel que soit l'endroit où vous vous trouvez. Dans votre sous-sol, votre bureau ou peut-être votre grenier. I would like to welcome you all, some 228 registrants I'm told, the result of an exceptional collaboration with some 7 association partners, the choice of relevant themes, but mostly the quality of our speakers and their associated organization. Thank you all. Allow me to take a few minutes to give you the genesis of this event and what FIAM's mission and objectives are all about. FIAM stands for Forum d'investissement alternatif de Montréal. The Montreal Alternative Investment Forum was initially created to assume the organization of a very successful summer social gathering, widely known today as the Mechoui. This event was part of a Canadian-wide initiative launched in 2014 during my time as Deputy Chairman of EMA Canada. This unifying event promotes exchanges between members of the financial community's ecosystem. Therefore, securing the presence of current leaders, semi-retired former executives, the rising guard, emerging managers, and a good balance of companies, including important service providers, is a key success factor that you certainly did not want to miss. At its 6th edition in August of last year, FIAM partnered with CFA Montreal to choose a laureate for FIAM Award of Excellence, whose career brought an exceptional contribution to the advancement of the profession. Sophie Palmer, former president of CFA Montreal and regional director and portfolio manager at George Lusky Fraser, was the recipient. FIAM has also started a scholarship program for CFA and CAIA aspirants in partnership with CFA Montreal and CASA organizations. Registered as a nonprofit organization, FIAM is a collaborative platform designed to assist or initiate events with the participation of association, organization, or institute in Canada and abroad who can contribute or share the same objectives, that is, the development of our investing community and its competencies. This virtual event is a good example of what FIAM aimed to bring together in a non-competitive spirit diverse, quote-unquote, partners to make possible the organization of an event or a project that brings real value to our investing community. In this context, and in partnership with la Caisse des dépôts et placements du Québec, FIAM is planning sometimes next year the organization of an important international conference on artificial intelligence and machine learning in capital market. The first step toward the creation of an international AI/ML ecosystem entirely focused on finance and investment. This would be, of course, leverage on the international reputation of Montreal in the AI space. I want to thank all of our partner association speakers and associated organizations. Thanks as well to our sponsors, TD, Scotia, BMO, Formula Growth, Crystalline, Alliance, Finance Montréal, and Virtue Financial. A special thanks goes to Claire Van Vick-Allen, the head of EMA Canada, who has been an inspiration in making this event possible. Also, Miriam Idru, Claire's right arm, for her invaluable assistance in the registration and the logistic process. As you all know, this program is very dense. 2 conversation in interview format, followed by 3 concurrent breakup sessions. Finally, the social network part that Claire will introduce later in the program. Unfortunately, there will be no time for questions. Moving on to the first part of the program, I will call on Sam Reda to introduce himself and interview as an interviewer of our first speaker, Marc Gauthier.
Bonjour tout le monde. Good afternoon, everybody, and to thank Claude for arranging this virtual event. I've been to each one of the physical ones in the past, and Claude, hopefully all of us will be together again next year. So my name is Sam Reda. I am president of my own consulting firm, Merrill X Capital, but many of you have known over the years, and I've been around in our industry for quite a number of years, actually. Come to think about it now, 43 years. And I am here today, and I am happy and privileged to facilitate a discussion with Marc Gauthier on moving to a sustainability mindset at Concordia University Pension Fund. So, Marc, if you're there, I'll just allow you to just say a few words first, introduce yourself, and then we'll get right into it.
Merci, Sam. Merci, Claude, encore pour l'invitation. Yes, my name is Marc Gauthier. I'm the treasurer and chief investment officer of Concordia University. I'm born in university. I've been there all my career, so over 30 years. I grew up there, mainly in corporate finance, but did a lot to make sure that I expanded my horizon. And so just briefly, maybe about my responsibilities, it's 4 divisions. One is all financial management and governance of 4 divisions, the benefits of the university, the pension plan, group insurance plan, and the financing of all. The investment, which is the pension fund and our foundations, and then corporate risk, which is our ERM program, and a risk financing program, and as well as our capital and financing, which is our CapEx program, our and budgets, and our financing and treasury programs.
So, Marc, maybe we'll get right into it. So why don't we just go back to the last, I guess, the great financial crisis, 2008, and maybe you can talk a bit about how the Concordia Pension Fund was managed at that time. Maybe a touch base in also on the investment policy you had in place back then, the governance which was in place, and maybe what were some of the lessons which were being learned out of that experience for the university?
Yes, so we're going back here at the beginning of 2007 when I took over. I guess the structure back then, could have said that it was somewhat standard industry. You had this one group committee that pretty much did everything. There was no subcommittee and no supporting management. And so it was, I would say that culture-wise, it was one that was focused on benchmarking themselves against other plans, focus on really just monitoring their portfolio managers, also from a culture's perspective, really about the headline risk. They just wanted to know, they were satisfied if they were part in the medium sense, and they wanted to stick out too much. Sort of the challenge in there as well is this one committee that ultimately ends up recommending they're approving their own recommendation, because that's all they had is each other to follow upon. And you also had a dominant personality, and that also tends to make the dialogue more restrictive. And at that time, the university owned 100% of the cost and risks, so there was little incentive for the members and the committee to look at only but the asset side of the ledger. So having a dialogue concerning the risk and revolving costs was very difficult. And also it was actually, it was HR driven. And so you had this sort of conflict of interest with the relationship with the employees and the members. But as well, for example, it's one of those structures that by the time I took over, which was before the crisis, it mentioned the guy who owned it, who used to run it, said, "Don't touch it, it's working well," which gives you an idea how little clue they had in terms of how much the risk they had within the overall plan and how they position itself. So to be more specific, that by that time the the policy was a traditional 60-40. And so it was only asset focused. Never looked at the liability side, but didn't really care for it. So it was, you talk about a big plan with multiple thousands of members, but pretty much run like a mom and pop shop. So this is, and even to the point that even the auditors were doing their own financial statements, which shows you how much the structure to supporting it was limited. So from there, I would say the lesson learned from that and the change that we made afterwards was one of the importance of having an effective and optimal governance structure in any organization, whether it's a pension plan or anything. If you need to, a governance structure needs to be able to make decision, and it needs to be to make decision in an effective and efficient manner. And to do so, you must have an ability to a structure that must challenge it itself. It must be able to challenge itself, make sure that it's comfortable, has looked at everything and going forward. And you can only have that with a lot of dedication and dialoguing, and certainly was not the case back then.
Yeah. So Mark, if we again go back just a bit after that period, in 2011, the university adopted a new funding policy, and then it took about 2 years to basically get a new investment policy, which was fully aligned with the funding policy. So in 2013, you get a new investment policy, which is aligned with the 2011 funding policy. And maybe you can elaborate on the thinking behind doing all of this, and why actually it might be interesting to also talk why it took 2 years to actually get the investment policy aligned with the funding policy.
It actually took a lot more than that. The process started, started even before the 2008 crisis, but certainly the crisis went through. And so it's actually more, I would say, it's a 5-year process. So funny enough that I used that term back then, and I'm using the term today because it's valid. You never want to waste a crisis to make changes. And this is what this was an enabler. The financial crisis was an enabler to make changes. So how I went about it is I initiated an enterprise risk management assessment. And it's twofold for that. An ARM assessment will allow you to, it provides an education to all of the members of the committee. And this assessment was engaged with all of the members of the committee, the pension committee. And what it allows you is allows some education into not only looking at all of the risk around the plan, but how integrated they are with each other. So that's one aspect of the value of doing an ERM to start off the whole transformation progress from going from a headline risk culture to a sustainable risk one. And the second element is that's the beauty is of a fiduciary obligation is that once you establish your tolerances with respect to your risk assessment, and once you establish risk and you score them above the tolerances, but then as fiduciary, you got no choice. You got to treat them. So that exercise allowed me the platform to make and the authority to make changes in a context that, as I mentioned before, they didn't feel like they make changes because they had no incentive to, because they didn't own the risk, and they felt that it's okay. It was part of they are blended with everybody else as to how they performed in 2008. So the ERM was the enabler. From that came a lot of risk, obviously, that were above our tolerance level, and we make risk treatment changes. So risk action were done. First was about just the pure infrastructure. We needed a system to get the data going to build an infrastructure. So one on the liability side and one on the asset side. So we went and established and developed and then implemented those systems. And then come establishing policies around liability and funding. So that's where this is where we got to the notion of developing a funding policy, which allows you to not only obviously develop objective, which in our case, nothing fancy. It was in line with the university and how its ability to be flexible in funding a plan, which is to seek to have a stable and sustainable costs over the short, mid, and long term, but as well establishes tolerances. So if ever it does something triggers, then it forces you to make some kind of not only action but at least a discussion around a review. And then of course you also outline your strategies within the funding policy. And one of the strategies, of course, is to align an investment policy to your funding policy, which led after that to the development of the investment policy. And so the investment policy, in our case, in the case for pension plans in Canada and Quebec, we're governed by going concern, not solvency. So at that time, and it's still the case, I guess, LDI was big, but LDI is based on solvency and so in the movement of interest rates. So you want to be relative to the market. In a going concern context, your liability discount rate doesn't move, irrelevant of the movement of the interest rate is based on your expectation of your investment policy. So if you think about that, it's actually a liability is actually absolute driven. Your liabilities are absolute driven. So in that case, what you want to design to align it is you want to align an asset allocation or investment policy that is 100% driven, absolute driven. So then you have the alignment here in this case, and that's what we did. So we went ahead and developed an asset allocation investment policy that is 100% absolute driven to be aligned with our liabilities. And so that whole process, I would say, is close to 4 or 5 years. And it was a lot of dialogue, and I must have invited over 20 what I call subject matter expert that come in and presented all kinds of various investment strategies, funding concept, and so to make sure that the whole committee is well informed, well educated, and after that we had a lot of dialogue. So all this process led to a very intensive, time-consuming concept, but it took a lot, I'll say 4 to 5 years, but it led finally to the approval of the new investment policy in 2013.
Interesting. Mark, you touched on it before in terms of the changes you had to make at the governance from what it was, I guess, before the last financial crisis, and what you had to put in place. You want to just elaborate a bit in terms of how the governance is set up? Yeah.
So really, the way it was set up is it was developed based on the concept of governance budgeting. So first and foremost, it spoke to the structure. Now, the structure, as I mentioned, I'm sure a lot of plans had it already in place, where you want is a segregation duty between management, a specialized subcommittee, and then your board. So that what needed to be taken into place. So we did that. So you get that segregation of duties, and we built internal management rules around it. So to ensure we get the proper segregation duties, the proper challenging of discussion at each level, and the delegation of duties. So that happened, but then the most important part happened, which is really the crux of the government budgeting concept, which is the dedication and of time and the allocation of time to specific topics. So in our case, I just mentioned, we have built this 4 or 5 years of time grouping, if you wish, of looking over many strategies, discussing, dialoguing. So there was a great momentum here in terms of dedication towards the policy, and the fact that it was done from scratch and built from really our own customized way. There was an ownership taking into account as well, along with a trust and credibility built between management and fiduciary members. So that momentum was built into really evolving our meeting structure to be a lot more frequent and a lot longer. So, for example, our investment subcommittee meets 11 times a year, and half of the time of those 11 times are half-day days, and the other half, or 6 times, are full days. So you can tell the dedication of time of the members in towards that commitment. And then you have the pension board, who meets 5 times a year, but all half days. And in each case, we have this concept of building an agenda that dedicates time to ensure that all aspects from discussion to compliance is taken care of. So we always begin with either education or discussion topic or topics that leads to the strategic reporting and more outlook. Then it drills down to the investment side. And then in this case, after that, we'll lead more to the compliance side of things, especially at the board level. So we make sure to dedicate this every time. And it's a discipline towards meeting this. We also develop really personalized reporting to the needs of the members. So listening obviously is huge. So we customize the report to how they want it, how they felt comfortable in understanding everything. So that was another thing. And more importantly, at the end, though, what resulted in this transformation, and I mentioned at the beginning, the key is if you want to transform anything, it's about having an effective and optimal governance structure. Is that there's a sense here of the culture now at all levels of the board of collaboration, respect, consensus building, but more importantly, and then you're part of it, Sam. So there's a lot of fun. People have fun, and they really take pride of what they built, and they own it.
Yeah, I think the next point maybe might be worthwhile covering, Mark, is just talking about the investment policy, asset allocation, and I think the three buckets, which I was going to say we use because, like you just mentioned, I've been involved in the process, and maybe talk about some of the strategies within each one of the buckets, because I think with the audience we have today, I think they'll certainly find that interesting.
Yeah, so I mentioned that it's so the alignment with the funding policy is that the investment policy with the funding policy, the investment policy will be 100% absolute driven. That's the alignment with the funding policy. But the design itself is really one I would categorize as skill oriented through a modular model, and that modular model allows the overall policy and its asset allocation to be agile, flexible, dynamic. So that's the purpose of it. And so what we seek ultimately is to be effective at all three sectors, if you wish, of the distribution of returns. So the left, the middle, and the right. So that's the holy grail we want to seek to accomplish. So in order to be dynamic, and what I meant by the modular model aspect is that we're merging here, we categorize the three buckets that you mentioned, Sam, which are funding objective buckets. So this is the alignment to the funding policy. And then on the other side, you have investment programs. So it can be a real estate program, it can be an equity program, it can be a fixed income program, can be infrastructure, ILS. So you have all the investment programs. A program itself has multiple strategies within each. And then is the merger of those funding objective buckets and the programs, which allows to be actually each can be slotted in all three areas. And I'll give you an example later on how one program is actually in all three buckets. But to be more specific, go back to, let's define those three buckets. The first one is what we call capital preservation. So for those who know me, I'm a big football guy. So this is my defense portion of I designed it in the football context. So this is the defense portion of the asset allocation. It's meant to be all dynamic, unconstrained strategies. That it's a combination of very complementary strategies to one to another. It can be multi-strats, can be multi-positioning, can be multi-asset classes. It's really about complementary to one another. But the key is they all have that one thing in common, that it is defensive first and offensive second when the opportunity arises. So capture ratio is big. This is a skill part we're looking for in that bucket, is the ability to not obviously capture much on the downside and seek to get a greater capture on the upside. So it's that's a summary of that. I would say that also there's the actual benchmark is cash plus 4. So that's our capital preservation bucket. Then we have our growth bucket, which is the offensive part of the allocation, the design. And in this case, you hear a lot about managers saying, oh, we're looking for singles or doubles. In this case, no. We're looking for triples and home runs in this category. It's really high conviction, high concentration. It's about really specialized knowledge and strategies that goes in there that seeks to have that what our benchmark to be cash plus 8. At this point, it's heavy equity, whether it's private and a variety of different styles, to public and a variety of different styles, but very concentrated strategies. So nothing general at all. It's very specialized. And I would say that the last one is the special teams, right? What's missing in football is special teams. Obviously, it doesn't fit well, so we call it diversification in our context. So these are meant to be cash flow oriented and or income type of strategies, but most importantly, it's meant to offset the risk of the growth bucket. So it's meant to be it's meant to be distinguished, disconnected from the financial markets. So in there, we'll have I got GP ownership, I got LP financing, ILS. You get a mixture of different types of private debt, private real estate, but it's not your traditional one. Some is concentrated in deferred maintenance asset. So the one is multi-dynamic or across the world. You also have some uniqueness on private debt, on private equity investments. So it's different types. I also got agriculture, infrastructure. So it's a mixed bag of those two, and it's a cash plus 6 strategy benchmark. So these are the 3 buckets, and they go back to my example of the real estate. In this case, our real estate investment program, we have a long short. It's in the capital preservation. We get a dedicated, specialized, concentrated one in the growth for direct investment, and then in the capital in the diversification, we got ourselves some. I mentioned before. Specialized investment into multi-asset class, multi-residential, high deferred maintenance investment type of strategies, and with a credit component into it. And we also have this dynamic allocation between funds of funds between the regions across the world. So that's to give you an example how an investment program is merged with all 3 of our buckets. Briefly, make sure that, okay, well, I know you have some other questions, so I want to talk about the targets. Briefly mention that the risk bucket, the risk budget is well spread between our growth and capital preservation, and diversification is completely reversed. It's just adding to the effectiveness of the risk budget. And we're complementing that with a capital program. Mostly right now at this stage is to manage risk, especially on the currency end, where we design a unique dynamic currency hedging program, but also looking to evolve to portfolio management and opportunistic.
Good, Mark. I guess if we go by the time we're allocated, we still have about 7 minutes, so I'm sure we'll be okay. Maybe just putting all of this in context, so what happened now in the COVID area, I'm just wondering if you can elaborate how the investment policy, asset allocation, the buckets did perform during, I guess, during the
yeah. No, so we're currently doing an assessment right now. We've done a preliminary. We're doing our final one in September because to me, COVID has that kind of event it requires from a government perspective an assessment. So like the old goal saying, never waste a crisis if you want to do changes, if any, but at least require an assessment. In our case, I would say right now, from a design perspective, I think the design did its job. It really did its job to the point. Capital preservation, protected capital, and then the performance of the diversification really offset the losses from the growth side. So from a design perspective, it really, to me, it did its job. I think what we're going to work on is to evolve, and we identified this before, our capital program to provide more agility in asset allocation movement, which is key in that kind of context. And so this is why we want to, I would say that we were still in development of implementing, but the ability to be more agile in respect to asset allocation, I think is what that we want to work on, that it was missing. And from a portfolio management perspective, I would say that 80% of our managers did or surpassed what I thought they would do, but 20% really, I would say, disappointed me or surprised me, seriously surprised. I'm sure they were surprised themselves from that point. So, and now the assessment comes forward is not only about what happened in the past, but also is it aligned to this new environment we're now in, which is post-COVID.
Yeah. So that brings me, I guess, the last question, and then I'll add something else. Just before we go to that last question, Mark, can you just say briefly, like that's what we've been doing at the pension fund level? Can you just make it just a very briefly a link with the foundation? Is the foundation also sort of doing the same thing?
No, the foundation is a much different governance structure. But I would say also the foundation, so it represents the university's values, where the pension plan is all about the members and their future and it's their own money. So in that context, the foundation we designed its alignment with the university. The university is big on sustainability. That's what it wants to focus itself on. It has a sustainability policy. So we already have evolved not only to be a UNPRI, but signatory, but also evolve into responsible investment and impact investment, which is a big and aligning the impact investment to the values of the university. But now we recently went a step forward, and we announced recently that we want to, by 2025, to be 100% sustainable, 0% into traditional energy, and doubling up our impact investment to 20%. So this will require a really different way of building a portfolio construction as allocation in the mindset of 100% sustainable, which is really, to me, very fascinating. So that's where the foundation is evolving at that point. Where the pension, I would say, it's obviously, I already explained it. What we can leverage the pension from the foundation is from the responsible investment policy and impact investment policy. So the pension had actually a responsible investment policy since 2009, but I would say it was a very passive one. And now we're in the process of evolving it. It's much different trying to evolve responsible investment in a 100% absolute structure context. So what will necessitate clearly is the recognition of the increased scope of governance of fiduciary obligation, respect to understanding the ESG impact within the pension fund and the pension plan, and then developing a measurement program around it that will seek to adjust accordingly if we see issue from a governance and fiduciary perspective. So those are involving. COVID has slowed the process of discussion, but we're getting near there. But I will say also what we can leverage most is trying to allocate allocate a portion of the impact investment strategy into pension plan. And then obviously we still need an indication at that point with the pension committee, but leverage the work being done at foundation and then try to seek and incorporate that. And that certainly impact investment has a place in each of the buckets, absolutely.
Mark, we only have 2 minutes left, so I think I'm just going to ask a very open question in terms of, and you touched on quite a bit of it already, but how do you see like the investment policy of the pension fund like evolve? What are some of the ideas you have like going forward, like which you will be bringing forward to the committee?
Yeah, so I mentioned, to me, from a strategic perspective, the effectiveness is as optimal as it can get from a risk-return perspective. I think what we want to evolve, and I think is what we want to evolve, is the agility of asset allocation I mentioned about, and really developing our capital program to be not only on the risk management one and above and beyond currency, but as well from a portfolio management and opportunistic point of view. So that's really will be a key focus, complementary to strategic design with more agility through a capital program. And also, I mentioned before, and so I would see also an increase in allocation towards our special team, our diversification. It's just been really outstanding how complementary it is and what it does from a return and diversification perspective. So I see that movement as well. And as well, the evolution of RI and II into that overall concept. So those to me are the three avenues orientation will be taking on.
Mark, I think it's exactly 4:35, which is the time they left us. I'm just going to finish in saying thank you very much. And by the way, I can confirm that there is a really good working family atmosphere in the committee. We challenge each other, but everybody's very respectful. And I think with your leadership, I think everybody is doing, I think is having a lot of fun in doing some pretty interesting things on the pension fund. So thank you very much.
Un grand merci, Sam et Claude.
Parfait, bonjour. Alors, ça va? OK, alors nous passons à la deuxième entrevue. Bonjour à tous. Merci d'assister à ce Mechoui virtuel aujourd'hui. Bonjour Vincent. Donc, good afternoon. Let's continue that virtual Mechoui. My name is Caroline Côté. I work at la Caisse de dépôt et placement du Québec. I'm the managing director responsible for the private market funds in Quebec, as well as our international venture capital funds. So as you know, today I have the great pleasure to discuss with Mr. Vincent Morin. So before giving a few words, just a brief bio. Vincent is the president of TransCanada Capital, TCC, previously known as Air Canada Pension Investments. Vincent joined TCC in 2009. Before joining TransCanada, he spent 12 years at Mercer. And something worth noting, Vincent was nominated in 2018 and 19 editions of the Chief Investment Officer magazine's Power 100 list. So maybe Vincent, a few words before we start.
So thank you very much, Caroline. Merci beaucoup pour cette belle introduction. Et d'abord, un grand merci à Claude Perron pour nous avoir invités. Thank you, Claude, for inviting us to participate in this great event. There's a lot of people, I understand, and we're very glad to be participating. Thank you.
Right, so let's dive into questions. So first one, of course, it's been a very successful decade for TransCanada Capital. Your performance over the years was a major contributor to the financial turnaround of Air Canada's Canadian pension plans. So from a 4.2 billion solvency deficit to a surplus of over 2 billion. It's quite amazing. So today, of course, we'll go over your firm approach. But first, let's maybe hear you about how the pension plan investment team evolved into what it is now, TransCanada Capital.
Yes, you know, it's TCC is a new enterprise. It's a brand new project, and we are very glad to have launched this new firm. But to give you some context, when you look at what happened at Air Canada pension plan for the past 10 years, you know, when we go back in 2009, the pension plan was in a huge pension deficit. At the same time, the great financial crisis hit, and actually the pension plan was making the headlines for Air Canada and the company for quite some time. It's been a legacy plan that we have been managing for years. Air Canada was previously a Crown corporation a long time ago with quite generous defined benefit pension plan. But when we became private, and we still had this pension plan to manage. And when you think about the pension deficit back in 2009 following the crisis at $4.2 billion, we are federally regulated, so we need to pay this deficit over a 5-year period. So $800 million every year of free cash flow that needs to be put in the plan. At the time when the market cap of the corporation is below $1 billion, it's basically insane. So the company had to do something at that point in time. They tried the traditional approach for years, the 60% equity, 40% bond traditional approach, but it didn't work, obviously. And so they decided at some point they needed to do something very different from what they've done before. The proposition that we made was to implement a brand new investment strategy, completely changing the focus and the asset class that we were using. So we had to innovate, and it implicated clearly a LDI approach, liability-driven approach to reduce the risk, and a lot of use in it with alternative products and new asset classes. So back then in 2009, when I joined the team, we were 5 people managing $10 billion in a very traditional approach. And we fast forward 10 years, and we are now 75 people in the team, managing over $23 billion in assets, mainly internally managed by the team.
Wow. I think one point the participant would like to hear is, what has been the turning point that convinced Air Canada to manage external client assets?
You know, it's a very good question, Caroline, because it's something that we know that many pension fund managers have their ideas on. Can we manage external assets? The thing is, in our case, we're in a very unique situation. At Air Canada, the pension plans are mainly closed to new entrants, and it's been the case for management plans since 2004. For other plans, it's 2012 and 2014 that were closed. And now that the plans are in surplus position and that the company has a clear plan of action to reduce and further the risk and eventually buy annuities for the pensioners, the challenge for the team, which was built to create this new stream of returns and new strategy, was changing. And actually, we know that the team needs to be around for the next 30 years because we'll be paying pension for quite some time in this plan. However, the challenge when you de-risk something is different. So recognizing that that Air Canada needed to invest in its team and retain the team, we saw that opportunity to offer basically our expertise and new approach to potential third-party clients and ensure the long-term sustainability of the Air Canada pension investment team.
Right. So if we come back to your new strategy, can you please explain us what does it consist of more specifically?
Yes, so if we go back to 2009, we had a 60%, 40% traditional approach. This approach generated significant asset liability mismatch risk. This was clearly not sustainable for the company. I know that in some jurisdictions, they changed the focus from solvency to going concern and funding policies. However, on a federal basis, we are federally regulated. It's the solvency that drives the show still. Also, when you are a plan that aims to at some point purchase annuities and that also is in a very cyclical kind of industry, the solvency is actually the only measure that matters because, you know, insurance company, the solvency basis is actually the cost of what an insurance company would charge you to purchase annuities. So ultimately, if you want to purchase these, this is the solvency that drives the show. So to make it sustainable for Air Canada, we had to introduce a very large scale LDI or liability-driven strategy to reduce the mismatch risk. However, we needed return as well because the plan still have an important number of active participants and a quite large current service cost at over $150 million per year to pay. So if you just go up there and purchase bonds and reduce the risk, the cost will become will just increase linearly with the lower risk profile that you have. So we have to get both lower risk but still have the return. So it was quite a tricky equation to get. So to get there, there was a few sources of solutions that we put forward with Air Canada to be able to achieve both objectives at the same time. The first one was first to reduce the traditional equity program, but we used three different new pillars that we implemented. The first one was a big portable alpha program through hedge funds, which would put up to 15% of the total asset allocation. The other one was the increase in fixed income investments using also some leverage to better reduce their asset liability mismatch risk. But the big distinction here was that we believe a lot in active management, and we believe active management can be a big source of the a big portion of the answer into solving a pension deficit. So active management was implemented heavily in the fixed income bucket. And the third pillar was the building of a very large allocation into alternative investments, which we define mainly as private assets, so real estate, infrastructure, private debt, and private equity. So we now have over 25% invested in this bucket. Actually, this strategy, when we implemented very gradually over the years, it worked very well. Our strategy actually generated over $8 billion of additional return when we compare that to a traditional 60%, 40% approach. Wow. And on top of that $8 billion, $5 billion came from the alpha component of the strategy.
Okay, so that's worth detailing, coming more a bit deep there. So let's talk about your first pillar, hedge fund. So of course here you said that it's an asset class where size matters. Your allocation currently stands at around $3 billion here. Can you please explain how you get there and how does it complement the other strategies?
We believe in, as I said, and I will say probably many times, we believe in alpha. We believe alpha can be a big component of a investment strategy. We build that in this component. It was quite new to invest in hedge funds for Air Canada back in 2009. And if you recall, with the crisis, which was driven mainly by derivatives investments in many banks, actually having to push a strategy where we did portable alpha, a lot of derivative products, and being Air Canada, which frankly we didn't have a quite good credit rating back then, was quite a challenge. But we were able to get there, convince everyone that if we build a portfolio that is prudently managed, very well diversified, with flagship managers and strong governance, then we could maybe actually achieve that. So we built two components in our hedge fund program. The first one, which we initiated very early back in 2010, is a fund of hedge fund. Actually, we selected external hedge fund managers, but with a very clear focus on making sure that this portfolio will not have any directionality. It's a portable alpha program, so we want to make sure that if the market goes down, this program won't follow. So, and we don't like to pay for beta. We like to pay fees for generating alpha, but so we created this fund and this approach. It was 10% of our allocation, so now it stands at $2 billion invested in over 15 different hedge funds, and we actually change our hedge fund quite often in our program because we want to be sure that these managers, again, are diversified, are pure alpha managers, and they work in a very niche kind of market segment so that they don't have the same source of alpha with each other. The goal of this program was to add 30 to 50 basis points to the total plan. It may not seem big, but at 10% allocation, it's actually trying to achieve 3 to 5% above cash. And we did it. The program actually achieved that over the years. The other component was an internal hedge fund, which actually started with our internal tactical positioning because we had to develop our alternative and derivatives expertise to implement our strategies. We quickly started to trade more and more derivatives and equipped ourselves into on the operational structure, trading structure, to be able to trade those instruments. So we started doing our internal positioning, and at some point we decided, okay, well, let's do a proper and very stringent and strict risk management approach, risk budgeting approach on all of our trades, make sure we diversify our trades, and build a risk system on top of that to make sure we don't drop the ball. It's very important. We have our fiduciary responsibilities on managing these assets. So we took that very seriously. So we started step by step, and eventually we realized actually that we were actually building a hedge fund. It was internally managed, but when we started comparing ourselves to what our external managers were doing, we realized that we were pretty much there. So it was actually gradually expanded very slowly, but we increased our assets under management into this actual internal bucket. We increased our number of trades, our breadth. We implemented systematic strategies, implemented some AI as well in these strategies. As well, at the same time, we improved our capacities in terms of monitoring the trades, operational structure, the number of ISDAS agreements that we have to trade those. So actually, it went quite well, and we now have in this strategy $1.2 billion invested by the Air Canada Pension Plan. And you know, the goal is to have uncorrelated returns. And when we look at the returns we got this year, for example, we were up in March, we're up in April, and actually are up more than 10% year to date in that actual internally managed strategy. So it did the job, and it worked quite well for diversifying the source of alpha for the pension plan.
Yeah, apparently. Vincent, how going forward with the with TCC, how scalable that strategy is without affecting performance?
We believe it's quite scalable. You know, we did some analysis, capacity analysis. We do trade very liquid instruments in there. Liquidity is important for this program. We give to our clients and to Air Canada actually 30-day notice to liquidate. So it has to be quite liquid. So we don't see much of a cap. We can easily triple or quadruple the assets managed into this strategy without seeing any problem. Once we get there, then we can reassess, but it's quite liquid.
Okay, so let's go to the second pillar, the fixed income, more traditional asset class. But here you introduce, as you said, a use of of derivatives. So can you explain us why did you do this and what are the benefits?
You know, the fixed income strategy for Air Canada, given its de-risking process that we are pursuing, we had to expand the exposure to fixed income, especially long-term fixed income, because it's a hedging strategy. However, when we started to look into this huge allocation for us, we realized that if this asset class was to be passively managed, it could lead to a very big opportunity loss. If you only have a very small portion of your plan working for you, let's say in equities or alternative investments, and you have this big portion of fixed income passively managed, there's a lot of assets that are not working for you. So, and we again believe in alpha, so we pushed a lot and tried to implement new strategies to actively manage the fixed income bucket. And over time, we developed our own strategy, and the goal was to internally manage that, because when we started in 2009 looking into long-term strategies and LDI strategies, all the offering was essentially passively managed. Some lever in this, but passively managed. But we wanted to actively manage this. So we built our own strategy, we developed it, we hired traders, portfolio managers, the operational structure. And when you compare to a traditional actively managed fixed income mandate, a traditional approach usually has only 3 levers to add value in a fixed income mandate. It's basically duration mismatch or duration bets. You have also the sector bets. Are you long credit? Corporate credit or long provincial credit, and there's the security selection, which tries to add some value, but there's limited opportunities out there. In the strategy we developed, we have over 12 different sources of alpha. We do trade swaps, we do trade curves transactions, we do trade sovereign credit, foreign credit, we do trade options, swaptions in this strategy. However, this is always done through investment grade products, because it's a LAR. The goal is the portfolio is there to reduce the risk for Air Canada. So it's not there to generate a lot of returns. We want to have some alpha, but controlled and sustainable. So it's investment grade. There's no FX exposure in there, because our plan is a Canadian pension plan. We have Canadian liabilities, so it needs to remain in Canadian bonds mainly. But we do arbitrage trades to generate some extra return if we can. So that's basically the strategy we implemented. We now have $17 billion invested in fixed income. So it's a huge portion of our expertise. And over the last 10 years, we added 1.1% above our benchmark on average. And we had no year down over the last 10 years. So 1.1% over $17 billion, you know, when you accumulate that over 10 years, it represents a lot of dollars, and given our large fixed income allocation.
Great. So let's go to your third pillar. So one thing I find interesting is the fact that you've built an alternative strategy from scratch. So for example, there is no obligation to meet an allocation target at the end of the year. This is a different approach, and maybe be curious to know how you feel it differentiates your firm.
Yes, when we started building the alternative program, we had the chance to start from scratch. There was absolutely no allocation to private markets at Air Canada back then. So we started from a blank page of paper. So we had the chance to design the way we wanted to implement this. And, we also had the opportunity to start that back in 2010, just following the great financial crisis. So we wanted to be opportunistic and flexible because there was some very interesting pockets of opportunities back then. And so we created that allocation with no fixed allocation to real estate, infrastructure, private equity, or private debt. It was actually our decision, the internal team, to allocate the assets within the asset class we wanted. So, for example, back then, the U.S. real estate market was quite distressed. So instead of buying core assets, we preferred to buy distressed asset, put lower allocation to it, but buy distressed asset, which we got that for a very small fraction of the actual value of these assets. And when they recovered, we actually did quite great. But then the cycle evolved, and more recently, just before 2020, actually, we decided to shift the program into more and less levered private debt programs and niche markets, which came from, at some point, some emerging markets, which provided better pockets of value that could be more resilient for if a crisis occurs. So we were very nimble, and it paid off. We were able to generate over 15% of IRR after all fees in this program over the last 10 years. So this was also a very big contributor to our returns.
Wow, great. So I think we covered those three pillars now. So that global new proposition that you're offering to the market, can you tell us a bit what's the market and your potential clients' reaction to your new strategy?
I think it's quite interesting, quite good. TCC has been created and registered as an asset manager back in 2018. We've been since then in a transition period to launch our fund offering. The funds that we launch is really to attract like-minded investors that, generally speaking, would be pension plans or endowments or people that have a quite long-term focus in their investments. So we created 6 different funds. Clearly, the first one we created is what we call our multi-strategy hedge fund. It's our flagship. It's actually our best ideas that are concentrated in a very well-diversified absolute return structure. Which is, again, invested heavily by Air Canada with $1 billion, $1.2 billion now invested in this fund, with, again, no correlation to the market. We also launched 2 actively managed, what we call high-octane fixed income funds, very well suited for LDI objectives, or liability-driven, so a very good match with liabilities, or for someone who want to pursue annuity purchase down the road. They are very well suited for that, but our goal is to add value on top of that allocation. And when you look at that, if you can add 1 to 1.5% of value above your fixed income portfolio, you actually double the yield, given the low yield. So it's quite interesting strategies that we believe in. We have 2 versions of this fund. There's one that is unlevered, traditional, and there's another one that is levered 2 to 1 to allow either a better LDI approach and risk management or doing portable alpha. We also launched our alternative fund, which is actually the alternative portfolio of Air Canada, which has now $5 billion in assets. So actually what we offer is to a client to invest alongside Air Canada in this program. And we also have two other funds, the equity fund, that is our equity program, which is has various sources of alpha with long short mandates, enhanced mandate 130-30, and also some passive management where asset classes are more efficient. And we have our multi-strategy or fund of fund program for the hedge fund, which we use for the portable alpha program. So we have 6 funds. The interesting thing is the alignment of interest that we offer. And that perception from clients, this alignment of interest is crucial, it's very key. Air Canada is invested heavily in these funds. We didn't launch funds for it's a la mode or it's something that people do want. It's really the Air Canada approach that we just repackaged and now can offer into funds for external clients. So it's the same track record, same team, same process.
So there's no customization, right?
There's no customization at this point. Actually, we've been asked the question a few times. We will be glad to do some customization because actually our processes internally that we developed are leverageable. The thing is, these are sophisticated strategies, so we need to have these in place. We also have the ability to make our clients profit from the scale of Air Canada. So, when you start a fund and you have $1.5 billion to seed that fund, the cost structure is very cheap for a client. So if you just start a new fund, then with a smaller asset base, then there's less economies of scale. But in our case, we believe that there's a big advantage to just tap along Air Canada.
Of course. Okay, so we have less than 5 minutes. Maybe I'll go to one question that's gonna recoup what has bin said in the earlier session. So you joined TCC. You joined actually the Canada Pension Plan in 2009 in the midst of a crisis. We now face a different crisis, an economic and a health one. So how would you describe the impact on your strategy and allocation today, but as well the impact 3-5 years from now? You see right now.
It's a good question. The current crisis is quite something that is, it's hard to predict that kind of crisis. Actually, no one could have predicted what happened this year. I'm pretty sure should you have asked someone what will be the main event in 2020, no one would have answered the virus. The thing that's important, I think, when you manage a portfolio is to make sure that at all time you get diversification in your portfolio, that you have sound risk management so that when a crisis hit, and again, they are not predictable, these crises, is that you keep your head calm and that you can navigate these turbulent waters with a cold head, so that you can be agile and profit from the opportunities that arise. So risk management is key to that, and portfolio construction, sound diversification. Again, there's no free lunch. There's only one free lunch in the market. It's diversification. If you diversify well your portfolio, usually it pays off. So that is very key. When you look going forward 3 to 5 years, what this crisis will show us is, I would say one word, is technology. Technology, we've done a leap forward 10 years at least. We just have this virtual Mechoui. It's incredible to be able to gather so many people virtually now. Just 5 years ago won't have been possible. So it will change a lot of things in our society, and we need to adapt. Investment is the same; it will be touched by that, and technology is there to stay. So someone who wants to keep pace with that needs to invest heavily in technology and systems to make sure that the investment strategies continue to be up to speed. Because AI is there, will stay, and will just be bigger going forward.
Yeah, big believer, working 100% on that. Okay, so another last 5 minutes. So I think 1 minute left. We're gonna conclude now. So thank you very much, Vincent, for sharing the TCC's vision, your views with us today. Clearly, you've done an exceptional job, you and your team, over the last decade. You seem to have all the ingredients to have the success with TCC. So. Thank you, everyone, for watching and listening. I hope you enjoyed the discussion. I invite you to join next the 3 breakout sessions, but those are on different links. So make sure that you can exit here and join the new links. Wish you all a great forum.
Thank you. Merci, Caroline.
Thank you. Merci, Vincent.